You can run $400,000 through your business a year, and the bank will still tell you that you make $80,000. That gap is why so many self-employed buyers get denied. It's not your income. It's the form they're reading. And I'll show you the write-off trap, the loan programs banks don't mention, and 3 myths that keep good borrowers renting. I'm Matt Jolivet, 26 years in the mortgage business, licensed in Oregon, Washington, and Idaho. And I see this trap catch business owners every single week. As of the latest federal count, more than 1 million businesses across Oregon, Washington, and Idaho run with no paid employees. If you're one of them, here's what actually happens when you apply for a mortgage. A conventional lender doesn't qualify you on what your business brings in, they qualify you on what's left after write-offs. Say your business does $400,000 a year in revenue. You write off $320,000 in real expenses, equipment, mileage, home office, all of it. Your CPA did that on purpose. It's smart. It saves you taxes. But now your paperwork says you made $80,000 a year, and that's the number the bank starts with. Sole proprietor, that number lives on line 31 of your Schedule C. S Corp or partnership, the lender reads your W-2 form from your own company and your K-1. Write-offs shrink those numbers the exact same way. So the better your accountant is, the worse you look to a lender. And S Corp owners, they get hit twice. They want proof the income actually reached you. In most cases, that means the distributions you took. Leave the profit in your business to grow it, and the lender may need proof the company could afford to pay you before they count it. And look, there are ways to document that. It's a broker conversation. But before you assume the answer is a more expensive loan, there are 5 adjustments that can rescue a conventional approval. Here's the part most borrowers never hear about. Some of those write-offs do get added back. Depreciation, it's a paper deduction, not cash out of your pocket. In most cases, it comes right back to your qualifying income. So can depletion, amortization, and the business use of your home. Documented one-time expenses may come back too. A good broker digs those out and rebuilds your real income. Sometimes that alone is just not enough to qualify. Every lender runs this analysis, but not every loan officer knows how to find every adjustment the guidelines allow. And when the conventional math still falls short, most banks have nowhere else to go. And if the tax returns still don't work, you've got other doors. Option 1, the bank statement loan. Forget tax returns. The lender reads 12 or 24 months of your deposits instead. They apply an expense factor, and here's what most people don't know. The factor depends on what type of business you run and how many employees you have. Say you deposit $25,000 a month into your business account. A retail shop with a few employees might get a 50% expense factor. That's $12,500 a month in qualifying income. But a solo consultant with no employees, one of my lenders uses a 15% factor for that. Same $25,000 in deposits, over $21,000 a month in qualifying income. That difference can mean hundreds of thousands of dollars in buying power. And some lenders may also take a CPA letter documenting your true expense ratio. And this isn't theory. I had a self-employed client whose tax returns qualified him at roughly $6,000 a month. We ran the bank statement review on the same business. His usable income came out to $25,000 a month. Same guy, same deposits. He went from barely qualifying to qualified. Look, every file is different, but that's what reading the right number can do. Option 2, the 1099 loan. If you're a contractor paid on 1099s, some lenders qualify you straight off those forms. Option 3, a profit and loss program, or an asset-based loan if you've built up strong savings. All 3 programs do the same job. They give the lender a different way to measure what you can really afford. Quick pause. If you're self-employed in Portland, Vancouver, Boise, or anywhere in Oregon, Washington, or Idaho, and you want to know which of these you'd qualify for, the link in the description goes straight to my calendar for a free 15-minute consultation. Myth 1, not always. Bank statement, 1099, and P&L programs don't use your tax returns to calculate your income. You usually still need a 2-year track record of self-employment, but the income proof is different. Not true. As of this recording, a bank statement loan might run a 0.5 point to 1.5 points over a conventional rate. With strong credit and a bigger down payment, that gap can shrink toward a 0.5 point. A slightly higher rate beats a flat no. It's the opposite on a conventional loan. Your accountant wants your income low. Your lender wants it high. Those two goals fight each other every April. If you're buying in the next year or two, talk to your broker and your CPA before you file. Here's what nobody tells self-employed buyers. A denial doesn't always mean you can't afford the home. A lot of the time it means someone read the wrong number off the wrong form. That's why the self-employed mortgage process works differently with a broker. You built a real business. Don't let a tax return tell you that you can't own a home. Send me your situation. 15 minutes and you'll have real numbers. I'm licensed in Oregon, Washington, and Idaho. The calendar link is right at the top of the description. If this helped, subscribe so the next one finds you. See you on the next video.